Hi, this is George Newberry. I will, there's still a couple more minutes and we'll get started. We'll let other people join in. Actually, I'm logged in under Brandy Walsh, so even though you'll see Brandy Walsh as the speaker, it's actually George Newberry. And basically what we're going to do today is we're going to go through American Homeowner Preservation, our 2015 A+ offering. We're going to share some details on on our upcoming acquisition that we're completing before the end of the year, and we are going to then open for questions. So any of you that have any questions, we look forward to answering them. I see more people logging in, which is great. So I'm engaging a little small talk just before noon, and hopefully give a couple minutes as people continue to log in. So I'm in Chicago right now. Weather, I'm not sure what it is outside, but it's probably around, my guess is around 40 degrees, which is unseasonably warm, which is nice. And so wherever you are, I hope you're enjoying the days leading up to these holiday days, and looking forward to the new year. I'm hoping everyone has a wonderful new year and succeed in all the undertakings that you are setting out for yourselves. Just some background on American Homeowner Preservation. It just turned noon, but I'm going to give some real quick background. We started out as a nonprofit in 2008, so we're almost 10 years old. In May of 2018, less than 6 months away, we will turn 10, which is a big milestone for us. We've evolved several times from that nonprofit. We became a for-profit, and in 2013, we started crowdfunding, and it's exciting as that's evolved, particularly and to the point where right now we're looking to close our biggest pool, fueled by crowdfunding. So it's now 12:01, so we're going to get started. So American Homeowner Preservation, this is our 2015 A+ equity offering, which is offered under Regulation A+, which is a regulation triggered by the Jobs Act, which allows us to raise up to $50 million from non-accredited and accredited investors. But first, let me give you an overview of American Homeowner Preservation. Our goal, when we started out in 2008 as a nonprofit, was to keep families at risk of foreclosure in their homes and help those families that are crushed by unaffordable debt. We've evolved into a nationwide buyer of non-performing mortgages, focusing on those mortgages, first mortgages secured by homes in low and moderate income communities. Those are typically loans secured by homes with values under $75,000. We also often take loans where there are issues. Let's say there are some documentation issues, there's missing notes or missing files, things like that. Even on higher value loans, we sometimes end up getting those. People often ask, are there still many foreclosures? Is this still that big of an issue in our country? And the reality is, it is. Although in many cases in the higher income and suburban neighborhoods, they have seen equity, a lot of appreciation, and home prices have risen. In the low and moderate income neighborhoods across the country, by and large, they've been left behind. These values have stayed flat or only increased modestly, and that is where the most help is needed, and that is where the opportunity lies. So that's where we focus our efforts. We've acquired over 6,000 loans since 2008, 2011. We've averaged over 20% returns in all of our funds. We've helped over 1,000 families stay in their homes. 1,000 vacant homes have been put back into service. So these are homes, and oftentimes in neighborhoods where, in some cases, every other home is vacant. We have gotten that home, either gotten a deed in lieu from the family or completed a foreclosure, sold that home, whether it's to an investor or a home buyer who's going to live in the home. It's taken a vacant home and put someone back in it, and we're trying to reverse that the decline in some of those neighborhoods. We've eliminated over $100 million in negative equity, and on an annual basis, each year, families are paying $4 million less on their mortgage payments as a result of AHP's intervention. Now, let's talk about this pool specifically that we're buying next week. In this, there's 458 loans. The average mortgage balance is $55,000. The total principal balance over all the loans, $25 million. That's what these homeowners owe on their mortgages right now. And the acquisition price that we're buying these loans for, $21,530 on average. The average home value, $52,000. Now all those are kind of typical for AHP. Maybe the value is a little bit higher than our average, which is around 40. But what is very unusual about this pool is that 32%, almost a third of the families, are less than 6 months delinquent. And so these families have been making payments. Maybe they got behind, but they kept making payments, and they've been able to keep it less than 6 months delinquent. That is extraordinary for us. On average, we're getting homeowners whose mortgages are 2 and 3 years delinquent, sometimes 6 years or even more. So 6 months is extraordinary. I think it presents an extraordinary opportunity for AHP to help these families who are just slipping behind, to get them back on track and to keep them in their homes. But that also means there are 68% who are more than 6 months delinquent, and that's a more standard AHP protocol where we go to those families and offer them their choice. If they want to stay, we offer them a modification. If they don't want to stay, we offer them cash for a deed in lieu or to cooperate with a short sale. Sometimes the home is vacant, and then we have to track down the homeowner and say, hey, you owe us money, but let's give you $1,000. You sign the deed, we'll forgive the rest of the debt. Those are ideal. A consensual resolution will almost always yield the greatest return. If we can get something done quick, without incurring legal fees, whether the homeowner stays or whether we end up getting the deed to the property, those are the ideal resolutions. So that's where we focus our efforts. Let me give you an example. People ask, well, how much can you make on these modifications? The numbers that we work with are often so low. How does this work that you're generating these high returns? So this is a real life example in Maywood, Illinois. Maywood is just outside of Chicago. And this gentleman, this family, had taken out a mortgage in 2003, before the crisis, $164,000. And in 2007, we had an appraisal in the file of $200,000. But then the crisis hit. And what happened? Many things, almost all bad. In 2010, this homeowner was laid off their job where they were at for 17 years, laid off. And what he did was he delivered water. Water, like in our office, every week someone comes in with all the bottles of water. That was his job for 17 years. He made a living, paid his mortgage on time, but now not only did his property value collapse in value, but also he was laid off. And he contacted his lender, which at that point was Ocwen, or Ocwen was the servicer. He contacted them about a modification, trying to find a solution to stay in his home. And Ocwen went through several rounds of getting documents and whatnot, but ultimately they denied his modification. And in 2012, when the property was revalued, it came in at $32,000. So look at that. The home value was $200,000 5 years before, and now it was $32,000. And then Ocwen told the homeowner that the modification was denied, and they proceeded to schedule a foreclosure sale. So a lot of bad news for this homeowner, but then something good happened. The lender decided to sell that loan to American Homeowner Preservation, and we bought that loan for 30% of the current value of the property. So even though he owed close to $200,000 on his mortgage with all the delinquent payments, we were able to buy that debt for $9,600. Again, 30% of the $32,000 current home value. And we reached out to that family and we said, hey, you're behind several years in payments, but if you give us $2,000, we'll accept that and we'll forgive the remaining delinquency. So you'll be up to date. For $2,000, you're completely up to date. And his payment, which was over $1,000 a month, will drop it to $320. And at first he thought it was a scam. He didn't believe it. He thought it was too good to be true. But ultimately, we gave him the documentation. He realized that, hey, these guys really do own the mortgage. And he went ahead with that deal. Now, how do those numbers look? I mean, it looks like $2,000 to forgive $20,000 or so of delinquency and dropping a payment from over $1,000 to $320. It sounds like we almost reverted to being a nonprofit, like that was a charity, but it wasn't. It was clearly a profitable venture. So in 2014, the year this first all happened, we took $2,000 in. He also made 10 $320 payments, so a total of $5,200 in return. Now look at that, $5,200 on a $9,600 investment. So that's a 54% return in the first year. And then this loan still had 18 more years to go on it. So we were receiving $3,840 per year for the next 18 years. That's a 40% annual return. So returns are exceptional. Again, now Wall Street, some Wall Street investors will look and say, okay, well, congratulations, George, your company just earned, $3,000, $5,000. It's just not that much money, even if it's a big return. And they're right, it's just not that much money, but you do it 100 times or hundreds of times, all of a sudden you have what we have now, which is a viable business. And not only are we generating good returns for our investors, we have come up with a viable, profitable business, and we're helping a lot of homeowners out along the way. It's very easy to invest. For those of you who haven't done so, I encourage you to visit our website. It's ahpfund.com. You can register. You can invest. Our minimum investment is $100. And we try to make it as accessible as possible so people can try it if they like it, and then let us prove to you that this really works. And once things work out, then we're hoping that you are inclined to increase your investment. But you can start out with 100. You could start out with 100,000. Whatever figure you're comfortable with, we welcome it. And you will earn returns. Our financial returns are distributed on the 10th of each month, roughly. If it's the weekend, sometimes it's the day after. And what we do is if you put in $100, that means you're going to get $1 each month on the 10th of each month as a return. And at one point, you'll get back your full $100. That's simply all we're distributing generally is actually your earnings. So what happens with that money? You put in $100,000, you put in $100. What happens with that money? We use that money to buy pools of mortgages, and these are non-performing mortgages. They're purchased at significant discounts. We then work with the homeowners to find sustainable solutions, whichever they want. They want to stay, they get a mod. They don't want to stay, they get cash for a deed in lieu, and we forgive the remaining debt on their loan. On a monthly basis, you receive your returns, and the cycle continues. As that money comes back, we reinvest in more loans. Our impact, these loans are across the country. Again, they're typically concentrated in low to moderate income neighborhoods. These are modest neighborhoods, and generally, so they'll be modest homes. I mean, here's a sample. These are actual homes that are in this current pool that we're acquiring, and they're across the country, from New York to Texas to Ohio, North Carolina, Pennsylvania, and they are in almost every state. In fact, American Homeowner Preservation has purchase loans in every state of the union except for Wyoming. Wyoming is the only state we have yet to acquire, and it's nothing against Wyoming. It's just lightly populated, and we haven't gotten a loan there yet, but I'm sure we will in time. We've even bought many loans in Alaska and Puerto Rico, and even we bought one last year in Hawaii. So the mission is truly a nationwide mission. And these are families, I mean, these are families that many a time it's still fallout from the crisis that occurred in 2007, 2008, 2009, but also even families who survived that devastating blow of that turn in the economy, even though they continue to make their payments. You know, at one point in time, many families get hit with an unexpected medical bill, with a divorce, with a death in the family. Any of these things could set a family back, and all of a sudden they're a few payments behind, and they're at risk of foreclosure. And unfortunately, in our country, many servicers and lenders, want you to bring everything up to date. They're not really going to work with you, by and large. And so these families end up at risk of foreclosure, and sometimes they come up with some of the money, but not all the money. And it's tough for them to get out of that hole that's created oftentimes temporarily. So our goal is to keep those families who are struggling to pay their mortgage and find solutions to keep them in their homes. Now here, why invest? I mean, this is good news, really good news. We were really excited when this first happened. It was just over a year ago when we were qualified by the Securities and Exchange Commission to offer our investments not just to accredited investors, and accredited investors are wealthy investors, investors whose net worth is $1 million or more, or have an annual income of $200,000 or more if they're single, or $300,000 or more if they're a couple. And that is just a small fraction of the population. Maybe 5% of the U.S. population falls into that accredited investor category. Before May of 2016, we could only accept investments from accredited investors. But once we were able to get approval from the Securities and Exchange Commission to offer under Regulation A+, we opened up our investments to non-accredited investors who basically can invest up to 10% of the greater of their net worth or their annual income. And that's something for us has been very, very exciting. It really opens up our investments to just about anybody, even, and this has happened, some families who we've helped avoid foreclosure have come back and invested in AHP to help the next families, which, for me, from a social perspective, it seems it's just fair and it's right. And for me, it generates a really good feeling, and I hope it does the same for you. And even whether they put in $100 or $1,000, whatever they put in, it's just being part of this mission. Again, the low entry minimum, I think it's amongst the lowest of any of the major crowdfunding platforms, $100, and you're very, very welcome to put in $100 or whatever you feel comfortable putting in. Audit. Our 2016 audit reflected that we generated a 39% return and that we paid out 12% to investors. There's a link to the audit in the webinar, and we will share that. It's actually in the handout, so if you want to download it, you can feel free to do so. And investors get their profits first. Basically, what we do, here's how the money flows. As we earn these returns, we pay out the 12% to investors. And whatever money's left over after paying all our expenses and the distributions to investors, if there's excess money, that money, we don't get it. We basically put it back into buying more loans. And eventually, it's a 5-year fund. So our goal is for the first 2.5, 3 years of the fund, we're going to do just that. Every time there's extra money is reinvest and buy more and more loans. And then more or less in the 3rd year, we're going to stop doing that. And any extra money that we have will be utilized to repay investors on their capital. So in addition to simply getting your monthly return, you'll also get a return on your capital, with the goal that at the end of the 5th year, all investors are fully repaid, not only their 12% that they earned, but also fully repaid on their capital. And whatever's left is ours. And so we've really backloaded our compensation. And so what we want to do is make it as secure as possible for investors. So if there's a bump, let's say, there's a big market shift, which is very plausible that that happens over the life of this fund. Then if the returns drop for a period of time, then we're still able to pay out that 12% to investors, and we keep it, keep the fund viable during that downturn. And in fact, the reality is, I believe in a downturn, which is, being that real estate is historically cyclical, it will happen at some point, potentially in the near future. I think we will do exceptionally well in that environment. I think a lot of the just like in real estate, where the real estate market has by and large risen significantly over the last several years, there's been a lot of money has come into these non-performing mortgages. So we do have some competition here and there, not so much on the low-value loans, but it still has generally increased prices over the last few years. Once this market turns and starts going down, I think there's a great likelihood that the opportunities for us will grow significantly. And the downside is it will probably result in the value of our existing assets dropping modestly. However, since we purchase these assets at often 30, 40 cents on the current market value, even a 5, 10, 20% drop would have, we believe, minimal impact on the outcome of our existing assets, and much more than made up by the new opportunities and the greater opportunities that would happen in a downturn. We always put our social mission hat on first. So whatever we do, if a family wants to stay in their house, we're going to do everything we can to try and help them to stay. When we started out as a nonprofit, the goal was to keep families at risk of foreclosure in their homes. Today, as a for-profit, we still share that same mission. And what's extraordinary is, in this business, it's a very unusual situation in that we can do the right thing for homeowners, generate a good return for our investors, make money in the middle, and there's no real loser. I mean, it's a win-win-win, which sounds somewhat cliche, but all our money is made off the discounts that we buy these loans at. So if we buy the loan at a 50 or 60% discount, that's where we're making our money. And then it's just a matter of us executing our strategies in order to arrive at some resolution. And we can do that, keep our social mission first, and still generate fantastic returns. So for that, we feel good about it, and we hope all of you do as well. Liquidity. With 30 days written notice, we do offer best efforts liquidity. And just so everyone knows that they do that, so if you need your money, there's an emergency, or for whatever reason you need your money back at some point in that 5-year period, you're welcome to do it. And we've had liquidations, we've had redemptions in our current fund, and we've always been able to meet them within the 30 days, if not sooner. The only caveat to that is that if you do liquidate or redeem in the first 6 months, your returns go from 12 to 10. If you do it in the second 6 months, they go from 12 to 11. Outside of that, after 1 year, if you redeem at any point in time, you get to keep the full 12% returns. So that is a feature that we are excited about, and I think a lot of investors like the feeling, like to know that, hey, if I need my money, I can request it back. So as we enter this holiday season, we're hoping that you'll consider helping us purchase these mortgages, not only for the 12% return, but also to keep these families in their homes through the holiday season. There are a lot of these families, are at risk of foreclosure, may not make it another year unless AHP or someone else, somehow they find some other solution to stay in their home, and the acquisition by AHP is probably their best opportunity to do just that. So with that, I think I've given you a decent, hopefully what giving you some more information about AHP that maybe you didn't know, and that will help you make a decision whether this investment is for you. I also had a gift for all of you that have joined our webinar today. We're running a promotion whereby anyone who makes an investment from Thanksgiving through Christmas gets a copy of a book that I wrote called Burn Zones. And basically, Burn Zones gives the readers kind of the history of my personal history, how I made a lot of money, how I actually lost a lot of money, and how I have rebuilt myself through American homeowner preservation. And it's something I'm hoping you'd enjoy. It certainly helps you learn more about American homeowner preservation. This is only for people on the webinar, but I'm going to give you a link that you can, there's a link. You can click on it. You can put in your information to get a free copy of the book. And if you already have a book, well, first, I hope you enjoyed it. But also, if you've already received one, you're welcome to give it to a gift. Just give it as a gift to anyone of your choice, and you can go in there and just put in their information. So what I can do now is open this to questions. If there's any questions, please. Oh, I see there's already a few that have come in. So let me start answering, and we, again, welcome more. So the question is, do we only buy first lien or second mortgages, and what percentage of each? Great question. These are 99% plus are first mortgages. Once in a while, there's a second mortgage that's thrown in a pool, and the seller wants us to buy everything, so we'll buy that second mortgage, but they are vast majority are first mortgages. So if you want a percentage to each, I'd say it's 99% first mortgages, 1% second mortgages, and in fact, it's probably less than 1%. This is a great question. How do you feel the Puerto Rico market now beyond the human tragedy, and do you think AHP will be more involved there? I absolutely think that AHP will become more and more active in Puerto Rico. It is a market where we've had a limited amount of loans historically, but with what's happened with the hurricane and the aftermath and the very slow response and government support in terms of that response, we expect that unfortunately a lot more families there will have challenges paying their mortgages. At some point, those loans will be offered for sale, and we will definitely be looking to purchase them. I mean, it's like a two-pronged tragedy. They had the hurricane, and they've also had for several years an they've had economic challenges. So how much cash liquidity is maintained for operations and to allow for investors early withdrawal situations? So here's what we do. We, on any given month, homeowners are giving us deeds in lieu or properties that we foreclosed on are being sold. So those are oftentimes what generate the most cash into the operation each month. So those amounts are typically what we would use to redeem if liquidity is requested. We also will sometimes, if an investor wants to purchase another investor's interest, that's another way that we can exit if someone wants to enter and someone wants to exit. So we try not to keep a lot of cash on hand. It generally sitting in escrow or sitting in our bank account earning little or nothing doesn't do very well when we're paying 12%. So we try to keep a minimum of cash. That said, lately we've had, at some point we've had $2 million in the bank, which we don't like. And right now in escrow, I think there's around $1 million, and in our bank account there's around $200,000. So there's always a decent amount of cash that is available to cover redemptions or other needs. Primarily, to cover opportunities like the one that we're looking for next week. What states are these 458 mortgages? That's a great question. That is one that I don't have the answer for. The most common states, though, that I'm aware of in this pool are Ohio, Indiana, Illinois, Florida, New York, and New Jersey. But this pool is spread over the vast majority of states, and we can certainly we'll send out a supplement with that information, but a state-by-state percentage breakdown. And where do these loans come from? That's a great question. These loans were held by City Financial. So they were either originated by City Financial or by Associates Financial, which was taken over by City. And these loans were held in City for years and were just recently sold to a big hedge fund, and that big hedge fund purchased 20,000 loans, which is just a huge amount of loans. And what they did was they took the 1,000 loans with the lowest values and offered those to us, and that's what we're buying. And we're buying 458 now. We believe there'll be even more that we're buying in January. There was getting all the due diligence done before the holidays was a little bit of a timing challenge. So last week we just said, hey, we're approved on 458. That's what we're going to proceed on for year end. There'll be more, probably next month. But that's where they came from. So many of these families have been paying City Financial for years. They ran into trouble at some point, or they've just been running behind. And those are the loans that we're purchasing, mostly based on the fact that these are the secured by the lowest value homes in that large trade done by the hedge fund. And the question is, why are these banks selling them? They once they get delinquent, or in this case, City Financial, I think is winding down. I don't think they're operational in terms of originating new loans. At some point, these were sitting on City's books, and they just decide, hey, this is something we need to sell. And then the hedge fund says, hey, we bought 20,000 loans. These bottom end loans, let's sell them to HP. And that's basically how we got here. Finance, operations, and investments. So we have a team of about 22 people here, and for the due diligence, we use a title company called Pro Title. They run all our title reports. We use a company called Single Source, which provides us BPOs. And to elaborate, a BPO is a broker price opinion, which basically means a local agent will drive by the property, take some photos, and do a kind of mini appraisal, giving us their idea of what the value of that home is. So we did this on 1,015 loans, and some of that due diligence is still coming in. But on this 458, we have all the title reports, we have all the BPO reports. We put that together, and then we analyze what how delinquent the payments are, is the home vacant or occupied, and we assign a purchase price to each individual loan. And there's a formula which basically we use, and that formula, we can then increase it if the payments are pretty up to date, or decrease it if the property is in a state like New York where the foreclosure timeline is long, or there's some other reason why we should decrease that bid amount. But that is the process that we go through. And we do have people here who have worked, the person who leads our trading desk worked at a loan sale advisory firm here in Chicago for more than 15 years, and she was the number 2 person there, and she is now leading up our trading desk, and she's the one that leads due diligence. And we look to buy these at a conservative fashion, and we turned in due diligence on 800 or more loans, and we only ended up getting 458, and the seller said, hey, on these other ones, you just cut the prices too low, we can't take them. And so that's what we have. In terms of operations, we have myself, Maria Kelly, we have a number of other, Jim Borski, we have a number of other people who have worked at in other management capacities. We have 3 attorneys on our team in our office that are in-house, working on these transactions. So there's a pretty robust team in terms of resolving these, and we also lever off third-party servicers and other vendors who help support our efforts. How are investors' funds protected? The protection is really in how low we buy these mortgages for. So if we, for some reason, had to liquidate the fund in a reasonable period of time and pay off all the investors, I think that could be done, certainly in today's market, and yield after all the investors were paid off, there'd be a significant amount. In fact, I'd encourage you to review our financial statements, which are filed with the SEC. There's an audit for last year, and also and this is available on our website, the 1SA form, which we filed with the SEC, included unaudited mid-year financials, and it showed roughly $900,000 or so in accumulated profit from the first year, which basically means that after paying all expenses, management fees, asset management fees, servicers, legal fees, property taxes, and paying back investors, after all that was done, we had an accumulated profit in excess of $900,000. from our first year of operations, and that has only continued to grow. So is there a contingency plan if HP goes under? Well, I'd hate to think that would ever happen, but it's a fair question. So what would happen if HP were to go under? So all our loans are held in a trust, and the trustee is U.S. Bank, and that in the event of the collapse of HP, there would the U.S. Bank could, I believe, appoint a new administrator of that trust. Currently, an affiliate of, or HP Capital Management is the administrator of that trust. Another administrator could be appointed in order to help facilitate the disposition of these loans. How much cash, one more, in what states are these 458 mortgages? I addressed that. We'll have to send a note on that. Okay, this happened to me and I'm just coming out of bankruptcy. I wish I'd known about your program and honored to become involved as an investor. Okay, I really appreciate that comment and I welcome your investment. And she also adds, thank you for all that you do. Well, great. I really appreciate that comment. Very nice of you. What are the SEC filing? And I'm sorry to hear you just came out of the bankruptcy, but hopefully you can rebuild from here. It can definitely be done. What are the requirements? The SEC filing requirements for AHP. At a minimum, we need to file a 1K, which is an annual report, which includes our annual audit, and we have to also file a 1SA, which is our semi-annual, which includes unaudited financials. And basically, they also include a narrative. Both reports include a narrative on the operations. I'd encourage you to view them. They're available on AHP's website as well as the SEC's website. Will the reduced monthly payment in the example, what balance would remain on the 40-year note? So here's what we do. When we do a payment reduction, we typically simply leave the loan the same term. So in the example I used, there were 18 years left on that loan. And so the payment before was $1,000. We dropped it to $300, but we still want it to pay off in full in 18 years. So there's no balloon payment or anything like that. So what we do in that case is we drop the interest and or the principal in order to accommodate that. So that is usually the biggest driver is the interest rate, and that would be dropped as needed. And so the specific answer to the question is, what balance will remain at the end? Zero. The goal is to have no balloon payments, nothing due at the end. Let me just see what else we have in terms of questions. Do we have many investors investing the minimum 100? Absolutely, the answer is yes. We have many investors. We were just actually looking. We've had over 3,000 individual investments in this fund, and there's plenty of investments that have occurred at $100. Now, what happens is we see many people who will invest 100, and then a few months later they're investing 1,000 or 10,000, and it grows from there. But we often see the $100 as being, or $100 or 500 or 1,000 as being an easy entry point for people to get acquainted with the fund. And the question: can you have a recording of this webinar? Absolutely, yes. I believe we will be sending out a recording to everybody who is on the who attended, and maybe even some others. So we'll get a copy out to all of you. Let's see. This is a good question, and we do get this once in a while. For the units that the owner doesn't want to stay in, well, we have first look to acquire them. And so can an investor, an AHP investor, can they get priority to purchase the real estate that we take back? At this point, there's no mechanism in place to do that. We're hoping to build some features into our website to maybe show coming soon, and then maybe once someone agrees to a deed in lieu but it hasn't been signed, maybe we can share that with AHP investors to see if there is an interest in acquiring and then maybe sell it quite rapidly. So that's something where we don't have the functionality yet, but stay tuned. Hopefully in 2018 we'll have that functionality so we can give a first look to the HP investors. Let's see. Okay, I think that is that's all the questions, or at least all the questions that we have time for today. So if anyone has an additional question, I welcome you to email or call us at any time with that question. We'd be more than happy to answer it in person. And once again, I appreciate everybody's interest today, and I hope that I hope you all consider investing in this fund and helping out these homeowners. And I wish everybody happy holidays. So thank you again. Again, any questions that come in or come to mind after this, then please give us a call or an email. I hope I answered every single question that was on here. Here's one more question squeezed in. This is how the proceeds treated for tax purposes. Everyone will receive a K-1, and from that K-1, there'll be it'll be a combination of ordinary income, which is basically the interest that was earned, as well as short-term and long-term capital gains. Probably in the latter years of the fund, it'll only be long-term capital gains, but it'll be a mix. And historically, most of the incomes comes through as capital gains. And let me just do one more run through. I don't want to leave anyone's question out. If they well, thank you. I appreciate some of the thank yous. That's very nice. The webinars, we will have more regular webinars. I appreciate that. Someone's asking for more regular webinars, and we will do that. Do we publish the addresses or the zip codes? Yeah, the addresses, we'll do a state-by-state breakdown. That was requested, and we can probably almost give a little more detail. See what we can do, and we'll give that, we'll share that via an email blast. And the next question is, can monthly payments be reinvested into the fund? And the answer is absolutely yes. When you make your investment, you can make a choice to either reinvest or to receive them out as cash each month. So make that election when you make your investment. And again, I don't think I missed anybody. I apologize if I did on your questions, but please go ahead and give us a call if I missed you or if anything else comes to mind. Thanks to everybody. There's one more. Okay, there's one more question. This will be the last one. Do we have to submit our earnings to other states? Doesn't need to file for other states. So here's what happens. In some cases, we're trying to mitigate. Once in a while, there's some states require that, let's say, it's not so much if you have a mortgage earnings in a state, but if we take back an REO and we sell that REO, sometimes that will generate state level income tax, and that is something where it will appear on your K-1. We're trying to do it so that it's done at the entity level, so it doesn't trickle down to each investors. Not all states permit that, so that is something that you'll see on your K-1. And I think that is the last question. Any other questions? Feel free to reach out to us. And again, thank you everybody for attending. Have a wonderful holiday season, and we look forward to 2018, and we hope it's a wonderful year for you and everybody. Thank you very much. Right there, done. How'd it go? Yeah, I think we did pretty well. I think a lot of questions, a lot of